Hi everyone, welcome back to the individual taxation classes. This class is part 3 of the retirement plan. Please go through part 1 and part 2 as well before jumping into this, because this is in continuation of that. In this particular video, we'll be discussing the simplified employee plan, that is called SEP plan, and then we'll do certain practice question. So let's dive into to understand in detail about the simplified employee plan, and then we do some practice questions. So other retirement rules. Other retirement rules, first one is self-employed person. So self-employed person can make a deduction or contribution up to $57,000 for financial year 2021 for the contribution to the qualified retirement plan. I think that's called 𝐂𝐨 plan. This also I think we have covered yesterday, right? And we have also covered the SEP, Simple Employee Pension Plan. This is also a type of IRA, have similar limit and been placed in replace the 𝐂𝐨 plan among all but high income professional who are establishing 𝐂𝐨 plan over the decade ago. So maximum limit is here also $57,000, and maximum deduction is 25% of the earned income or the contribution, whichever is lower. Another thing you should be aware of is the defined contribution plan and defined benefit plan. So here is a basic understanding. You should know about what is defined contribution plan and what is defined benefit plan. Defined contribution plan are basically the plan, retirement plan, in which employee and employer, they both contribute to the employee individual account under this plan. So here the responsibility of the employer is deducting the amount from the employee paycheck as well as equal amount he or she need to contribute and deposit to the contribution plan, which is being generally maintained by the third party. Most of the time we have experienced like it's generally bank or insurance company who maintain the contribution plan. The amount in the account at the distribution include the contribution and investment gain and loss minus any investment and administrative fee. So here the employer do not have primary responsibility to give commitment that at the time of retirement or after the retirement that employee will be getting this much minimum of compensation. Here they give it to the third party expert. Employer makes certain contribution, employee also makes certain contribution, and they deposit to the third party expert. And that third party expert make investment out of those amount, right? So some investment they make in the government bonds, or you can say highly secured bond, and some investment they make in the private equity also, similar to how the mutual funds actually work, right? And whatever is the earning they make out of this money, that is being added into the respective unit account of the individual. And at the time of retirement, individual will get the total contribution plus interest or dividend total earned minus if there is any administration fees or management fees of the contributor, of the you can say of the person or the company who is maintaining the contribution plan. On the second hand side, if you see right hand side, this is called defined benefit plan. So defined benefit plan is any plan that is not a defined contribution plan. So the plan which is not a contribution plan is generally considered as a defined benefit plan. But defined benefit plan is generally that plan which employer maintain and manage. So they have their own trust and they have the own trustee who maintain and manage the entire investment from the employer side and employee side, and they give certain minimum commitment that employee will be getting at the time of retirement and after the retirement. And they have such as restricted laws that they cannot make investment right, left, and center. So there are stringent norms to it. And they are also required to file 401k, right? The benefit to provide to each participant to the plan need to be clearly laid out in the plan. That means it's their primary responsibility when they are taking the money or when they are depositing the money of the individual, and that it should be clearly mentioned what all benefit they will be getting. And defined benefit plans are often more complex and thus more costly to establish and maintain than any other type of plan, because here a lot of like complexity in accounting involved, and a lot of judgments include, right? And at the time of specialized knowledge also include, and most of the time they require actuarial inputs also, right? So generally defined benefit plan, many big company, they run their own defined benefit plan. Most of the listed company I have seen in US, they have their own defined benefit plan. But for private company or mid-sized company or S corporation, they majorly go with the contribution plan because they do not have that much bandwidth and capacity and capability to manage and run the defined benefit plan, as it is a complex things to manage as well as highly regulated environment. So generally, like small company do not burn their hand in this category, right? But plan provide more predictable benefit, and benefit are not dependent on the assets return. So that is kind of mandatory benefit that company need to be provide whether the investment will be earning or not, right? That is the difference between contribution and defined benefit plan. Yes,
Sir.
Shubham. Hmm.
Sir, I'm asking, sir, then in this case, which will be much better if we like have a big size or a big firm? So they can go for the defined benefit plan. If there's a mid-sized company, they go for the contribution plan. But like to be on, like in the real situation, which one will be better to adopt? If
Yeah. So, like very can't be able to give straightforward answer, to be very honest. My, it's, like from the law side, both are okay, right? As an employer, you can participate in contribution plan or you can run on your own defined benefit. But you need to help your employee who is working with you for their retirement benefits, right? They both are, as per law, they both are eligible. Now the thing is, like maintaining and managing your own defined benefit plan, there you will collect the contribution of the employee, you also make your contribution, then you need to hire the team who can make the investment as per, you can say, the laws and the norms, right? And then they need to ensure at least the minimum return which they commit. For example, if I'm a manufacturing company, I may not have capacity or capability to hire investment advisors, because in this you require investment advisors, right? Now you require like asset management, you require like wealth management type of people, right? So that's not my core competency. So rather, I should go to the contribution plan where the people who have expertise, like big banks, Bank of America, Yes Bank, right, American Express, right? So they manage the contribution plan and they have like big team of good investment bankers, wealth management, asset management professional, and they manage it professionally and give good returns to themselves and to their employee. So in that case of scenario, I'll go with the contribution plan as an employer. Hmm? But if I can manage and run my own, then I need to give a minimum commitment to my employees that I'll ensure 8% return, 9% return, 10% return. And sometimes, like market fluctuate. And so it may result into a difficult position. So generally, to avoid any complexity in future, most of the company go with the contribution plan because their responsibility is to the extent of their contribution and submission of employee contribution to that company. Whereas in defined benefit plan, they have bigger responsibility.
okay, sir, much nice.
Mhm.
Yes, sir.
Right? Divya, Rajat, Garima,
Yes, sir.
correct?
Yes,
Okay.
yes.
So next is IRA distribution. IRA distribution, type of distribution. First is non-deductible traditional IRA. Non-deductible means when you have done the contribution at that point of time, the amount have not deducted. So you have paid taxes, right? So now when you are withdrawing after 5 years, 10 years, or 59.5 years, then the principal is non-taxable. But the earnings you are generating on it is taxable. Make sense? The other thing is when you have deductible traditional IRA, that means in current year you have paid less taxes, right? But in future, when you recover the principal at that point of time, that principal amount is also taxable, and the earning which you have generated on that is also being taxable in future. Next is qualified Roth IRA plan. So qualified Roth IRA plan is always a non-deductible, right? That means today also you have paid more taxes. So in future, it will be non-taxable on the principal. But the good part with the Roth IRA, qualified Roth IRA, that earning is also non-taxable. So hence, people invest more into the Roth IRA because in future, principal and earning, they both are exempt. They both are non-taxable. When you make a contribution to a non-qualified IRA, then at that point of time, principal amount which you are receiving is non-taxable because current year also you have paid more taxes. However, the earnings on non-qualified Roth IRA is taxable. Right? Make sense? Everyone, does it make sense?
Yes, sir.
Hmm?
Yes,
So
sir, yes.
if you look at the note, distribution from Roth IRA are considered to first come first from principal and then next from the interest or dividend or the earnings. So these 2 points we have noticed, I think, from last examples which we were doing. One second. If the taxpayer or taxpayer's beneficiary engage in a prohibited transaction in connection with the taxpayer traditional IRA account at any time during the year, the account stop being IRA as of the first day of that year, right? So if you are making any transaction which is prohibited transaction, if taxpayer or taxpayer beneficiaries engage in prohibited transaction, then account stop at the beginning as IRA or the first day of the year. It is not considered as IRA account. If the taxpayer is subject to 6% tax, the taxpayer is subject to a 6% tax if the excess contribution for the year are not withdrawn by the date taxpayer return for the year as a due. So this is like minimum, you can say, distribution plan. If you do not, the taxpayer is subject to 6% tax if the excess contribution for the year are not withdrawn by the date taxpayer filed the return. So if you are making more contribution, then you need to withdraw that contribution beyond the eligible limit or beyond the allowable limit. If you do not withdraw it, then you have to pay 6% taxes on it. Make sense? This we discussed yesterday also. Guys, any doubt? Are you guys here? Rajat, Mayank?
Yes, sir.
Okay,
No.
so let's do a practice of one quick small question. What is your maximum allowable deduction for a contribution to a Roth IRA if neither you nor your spouse was covered for any part of the year by an employer retirement plan in 2021? $6,000 if younger than 50, $7,000 if older than 50. Both the answer are correct or neither the choice is correct. What is your maximum allowable deduction
Sir,
for a
option
contribution?
option 4.
Why?
Sir, because if they are like if they are filing separately, then if they have been allowed by the employer, like they can participate in the Roth IRA. So, but as you can see, that they are not part of the employer retirement plan in the year, so they are not allowed. But if they have been allowed to the maximum contribution, they if they
No, your answer is right, but explanation is completely wrong.
नहीं सर, मैं ये कहना चाह रहा हूँ, अगर जो ज्वाइंटली पार्टिसिपेट करते तो 12,000 हो जाती, अगर जो 50 से ऊपर होता तो 14,000 अलाउड हो जाती.
No, explanation is
हमारी सर
completely wrong.
ऐसी हमारी क्वेश्चन में कोई बात ही नहीं होगी ना.
Huh?
ऐसी सर क्वेश्चन में कोई बात ही नहीं है ना कि मैक्सिमम अलाउबल कंट्रीब्यूशन.
Say that again.
सर क्वेश्चन में तो डिडक्शन की वो ही नहीं है ना, क्योंकि जो वो उसके लाइक वो उसमें पार्टिसिपेट ही नहीं करा उन्होंने रिटायरमेंट प्लान के अंदर 2021
Okay,
में.
let's hear other also. Yeah,
Sir,
Mayank, Rajat.
sir, like 6,000 and 7,000 are correct if it is only Roth IRA, but it is not but it is mentioned for your spouse covered for any part. So these both are correct for the simple Roth IRA. So they both are wrong from my this knowledge.
Sorry, I didn't understand your explanation. Say that again.
Like sir 6,000 and 7,000 फर्स्ट के दो आंसर्स है सर, वो सिंपल रॉथ आईआरए के लिए मैंने पढ़ा था, अभी हमने ऊपर डिस्कस किया था, बट उसके लिए मेरे को अमाउंट तो नहीं याद, बट ये दोनों राइट नहीं है, ये दोनों राइट है अगर सिर्फ सिंपल सिर्फ रॉथ आईआरए होता तो.
What
So
is the call of the question? What exactly question is asking you?
what is the maximum allowable deduction for contribution to a Roth IRA? But the main call is that if neither you or you nor your spouse was covered for any part. So like we have discussed like I don't remember right now the spouse wala part, but I remember that in which discussed and without spouse part I'm not able to like justify my answer, but in the only Roth IRA we have studied 6,000 if 50 or older than 50, but
Okay, Rajat, you want to attempt? Vivek, would you like to attempt? Garima?
So we have studied that the Roth IRA like can't be more than $6,000, but the $7,000 only if your age is 50 or older than that. So the answer would be 4, like neither answer.
No. What is the call of the question? Okay, help me understand again.
They're asking about the maximum allowable deduction.
So Roth IRA are deductible or non-deductible? If you go to the very first chart, is Roth IRA. So Roth IRAs are not deductible. That's the reason both the choices are incorrect, right? Right, Shubham?
Yes.
Garima, got it?
Yes, sir.
Mayank?
yes sir, yes.
Because principally they are not deductible. You cannot reduce that as an itemized deduction, right? Right, Rajat, got it?
Okay.
Okay, yes or no?
Yeah. Got it.
Okay, cool. Okay, so next topic is rollover and conversion of retirement plan. So rollover and conversion of retirement plan. So first is rollover from traditional IRA to Roth IRA. So as transfer from deductible traditional IRA to Roth IRA to be included in the income at the time of rollover or transfer with no 10% early withdrawal penalty. So that is waiver. So what does it mean? You go to the Excel sheet. Let's try to make it out here. So let's assume in 2020, 2021, and now it is 2022. So you are making a contribution to traditional, which IRA? Deductible. So let's assume you are making $5,000 contribution and you made $5,000 contribution here. Now in 2022, you want to convert to Roth IRA and contribution to So now you want this $10,000 to convert to Roth IRA, right? And in current year, you want to make a contribution to Roth IRA. So in financial year 2021, in financial year 20 and 21, the formatting, right? So in the financial year 2021, you have taken this $5,000 as deductible. That means you have paid less taxes. Let's assume 20%. So that means in this 2020, you have paid how much less taxes? $1,000. Here also you have paid less taxes, right? And now you are saying it has to be converted into the Roth IRA. So in this year, you need to pay 2,000 taxes. Make sense? Why? Make sense? Why? Mayank? Rajat?
So I was busy in changing the Wi-Fi route, sir. But could you please repeat that again, sir? 2,000 parts.
Rajat, have you understood? Vivek? Sachinji? Shubham?
Yes, sir.
All right. Shubham, do you mind explaining to the group?
Yes, sir. 2020 में सर जैसे हम ट्रेडिशनल डिडक्टिबल यूज कर रहे थे तो 5,000 हमारा कंट्रीब्यूशन था. सेम वे 2021 में 5,000 हमारा कंट्रीब्यूशन था. डिडक्टिबल में जैसे हमारा क्या होता है कि हम अपनी ग्रॉस इनकम में से वो डिडक्ट कर रहे हैं, आइटमाइज्ड डिडक्शन ले रहे हैं. तो जब हम एजीआई पे आते हैं तो हमारी जो इनकम है वो कम हो जाती है, तो सबके ऊपर सर कम टैक्स लगता है. तो कहने तो जब हम इसे कन्वर्ट कर रहे हैं तो अब हमने टैक्स कैलकुलेट करके देखा कि हमने कम टैक्स कितना लगाया. 5,000 के ऊपर हमने 20% का कम टैक्स कितना लगाया था. 1,000. सेम वे 2021 में 1,000. तो जब कन्वर्ट कर रहे हैं अब रोथ में, तो सर रोथ में इन दोनों का टैक्स कितना बैठ गया? 2,000 की हमें पेनल्टी देनी पड़ेगी.
Yeah, everyone got it? Or man, do you want me to explain again?
No, sir, it's all clear.
Garima?
Yes, sir.
Shall I explain again?
No.
Sure?
Yes, yes.
No worries, I'll explain again. So, for example, in this example, if you see, in 2020, right, we have considered traditional deductible IRA and we have deposited $5,000. So that $5,000 we have considered as itemized deduction in 2020 and 2021 also. So we have paid less taxes in previous year. But now we are converting the traditional deductible IRA to the Roth IRA for future. Right? If it would have been a Roth IRA since beginning, then you would have been paid taxes on 5,000, right? So you are taking the retrospective impact and correcting it like it was always via Roth IRA. So hence, this $10,000 is taxable in current year. But good thing is that you will not get 10% penalty on the withdrawal because it is transfer. Make sense now?
Yes, sir.
Rajat?
Got it, sir.
Pakka? Right? So I'll put this also in the notes so that you have these details for ready reference. Okay. So withdrawal allowable to the amount transferred from traditional IRA cannot be made until those amounts have been in a Roth IRA for at least 5 years. So you need to keep at least 5 years in a Roth IRA. Right? Early distribution penalty, this also we have discussed yesterday a bit. Right? It's very much similar. 10% penalty on the earning if distributed before the age of 59.5 years or before the 5 years of the contribution, except for qualified medical expenses, health insurance expenses, qualified higher education expenses, or first time home purchaser, maximum $10,000. Right? So early distribution penalty is how much?
10%.
10%, right? So Roth IRA are the best when you think your tax will be higher in the retirement than they are right now, right? So in future, if you are expecting your taxes will be more as you are becoming more and more wealthier, then you will be investing in Roth IRA so that in future your tax liability will be less. Okay, so rollover must be completed within 60 days. So whatever the rollover you are making from deductible traditional IRA to Roth IRA, non-deductible traditional Roth IRA to Roth IRA, or from deductible to non-deductible or non-deductible to deductible. Whatsoever the conversion or rollover you want to make it within 60 days, right? If you are making it after 60 days, then the treatment of the rollover is considered as a taxable distribution. And you need to pay tax as a distribution on the entire amount, right? So rollover after the 60-day does not consider as qualified rollover, and you need to pay taxes on the entire amount. Consider the entire amount is a distribution. Second thing is you need to pay additional 10% taxes, which is your penalty for considering the rollover as early distribution. So both are taxable, like entire amount is taxable. In addition to that, early distribution penalty of 10% is also levied. Make sense? The next is when 60-day period expire in the following year. Let's assume you have planned to roll over in the month of December, 1st December, you plan to do the rollover and you have withdrawn from one traditional deductible IRA. Then you need to make the deposit before 30th January of next year. Otherwise, even though the rollover is falling in the next year, but is considered as a taxable in your current year income, right? For example, on 1st December 2022, you plan to roll over from traditional deductible IRA to the Roth IRA, and you have withdrawn the amount from deductible traditional IRA. And now you have to deposit this amount as a rollover in the Roth IRA on or before 30th January 2023. So if you have deposited in the Roth IRA on or before 30th January 2023, then it is considered as a rollover, right? And then rollover principle will apply, which we have discussed above. But if you fail to deposit to the Roth IRA on or before 30th January of the next year, then it will be entire amount considered as a distribution. And when it is considered as a distribution, it will be considered as a distribution of the year 2022. And you need to pay taxes and file the return on or before April 15, 2023, right? And on this amount, you need to pay 10% early withdrawal penalty also. Make sense? Rajat, Mayank?
Yes, sir.
Garima, got it?
Yes, sir.
Yes,
Vivek? Okay.
Yes, sir.
So here is a quick summary. Quick summary of the rollover permitted between the various type of qualified plans. So what all rollovers are permitted, what all rollovers are not permitted, right? So majorly you will see in your exam is Roth IRA, traditional IRA, simple IRA or SEP. Other are, just, we have so many plans in United States of America, just to consider the completeness. So rest of them are here, but majority you will see Roth IRA or traditional IRA, and sometime you may see simple and SEP also. So in left hand side is the rollover from, like from which plan you are rolling over to which plan you are rolling over is in right hand side. So if you see the second column, Roth IRA, traditional IRA, and all those which is mentioned in the second column is being from where you are transferring. On the top side, you will see to which plan you are transferring. From where you are transferring, it is in second row, and to which plan you are transferring is in the top row. Got it? So first see Roth IRA. Roth IRA can be transferred to another Roth IRA, but it cannot transfer to traditional IRA, simple IRA, SEP, 457 plan, qualified plan, 403 plan, or any other. Right? So Roth IRA, very simple, straightforward. You can convert into any other Roth IRA, but you cannot convert into any other plan. Simple, straightforward. Yep, sounds good. Traditional IRA. Traditional IRA can be roll over to the Roth IRA or to the another traditional IRA or to 457 plan or to the qualified plan or 403 plan. But cannot be rolled over to the simple plan, cannot be rolled over to the designed Roth plans, Roth account, right? Same way, simple IRA, that can be transferred to the Roth IRA, but after 2 years, not before that. That can be transferred to traditional IRA, but after 2 years. And simple IRA can be transferred to another simple IRA. For that, there is no limitation. Right? So simple IRA, if you need to transfer, the minimum requirement is keeping into the simple IRA for at least 2 years, right? Whether you want to convert or roll over into Roth IRA, you want to convert or roll over into traditional IRA or to the SEP 457 plan, qualified plan, or 403 plan. But you cannot convert the simple IRA plan to the designated Roth account 401k. And next one is SEP IRA. SEP IRA can also be converted into Roth IRA, traditional IRA, but cannot be converted to the simple IRA, right? And another is qualified plan, 403 plan, designated plan. So it's very simple, straightforward. But for you, important is Roth IRA, traditional IRA, simple IRA, and SEP. These all are not very important, not heavily tested in exam. right? If you do this much, I think you are good. So for your simplicity, I can keep it like this, right? Any doubt in this table? Anything you guys need clarification on this table? Mayank, Garima, Rajat, Sachin, all good? Okay. Okay. So then we have last topic, which is minimum required distribution. So maybe here we can take a break, right? And after the break, we'll finish off this last topic of IRA, and then we'll do few questions to practice. Right? It's 5:50. We can come back at 6:20. Sounds good?